The physical commodities market moves millions of tons of energy, metals, and agricultural inputs across oceans and continents to support the global economy. Yet, as this photograph of a legacy trading floor illustrates, the financial infrastructure that governs these assets remains anchored in the past. We are dictating the price of modern physical logistics using mechanisms originally designed for open outcry pits and manual boards. Trillion-dollar markets rely on siloed ledgers, fragmented paper databases, and bilateral contracts. The physical goods move at the speed of modern freight, but the ownership records and pricing data move at the speed of paperwork. This gap produces a compounding hidden tax known as coordination debt. When participants cannot easily share a verified reality, the friction of simply establishing who owns what and what it is worth slows down trade and introduces risk. In commodities, coordination debt manifests as systemic vulnerability. It creates environments where pricing panels operate in the dark, paper delivery documents are forged, and environmental compliance relies on self-reported corporate claims. Resolving this requires a structural intervention. That intervention is the commodities WAO, or Wise Autonomous Organization. The WAO does not replace existing commodity exchanges. It functions as a neutral market integrity steward layered on top of them, providing the shared governance and verifiable data that commercial exchanges are too conflicted to build themselves. The bedrock of this architecture is the Wisdom Vault, a shared, verifiable ledger anchoring physical assets to programmable rules. Within it, specialized AI agents continuously read data, enforcing rules to mathematically neutralize market vulnerabilities before human intervention is required. The WAO architecture strips interpersonal trust out of the equation. It shifts market confidence away from conflicted financial intermediaries and anchors it directly to cryptographic, sensor-verified truth. Consider how commodity prices are discovered. For decades, the industry has relied on panel-based benchmarks. This method has a structural vulnerability. Pricing depends on subjective, self-reported estimates submitted by a small panel of financial institutions. A single conflicted node can sway the central market price to benefit its own trading book. The consequences are a matter of public record. The LIBOR scandal and multiple metal benchmark manipulations persisted specifically because the mechanism relied on institutional honor rather than verifiable data. Traditional regulatory oversight struggles to catch this behavior in real time. By the time an audit reconstructs the messaging histories and identifies the false submissions, the market has already cleared trades based on manipulated prices. To counter this, the WAO deploys the Benchmark Transparency Agent. Instead of asking banks for estimates, this agent aggregates actual, verified transaction data directly from member participants. The legacy panel system required humans to manually compile daily submissions. The agent processes raw transaction data continuously and autonomously, calculating a benchmark that reflects actual market activity at millisecond speeds. Because the resulting price is tied directly to an immutable cryptographic history of real trades, it cannot be spoofed by a single bad actor. By tying benchmarks to thousands of immutable transaction records, the Benchmark Transparency Agent makes the cost of manipulation higher than any potential gain, retiring that risk from the market. However, the accuracy of a digital price is irrelevant if the physical delivery of the commodity itself remains a blind spot. The industry's most expensive delivery vulnerability is double financing. The fraud mechanism is straightforward. A warehouse manager takes a single physical pallet of copper or grain and issues multiple duplicate paper receipts for it to different lenders. Each lender issues a loan, believing they hold exclusive claim to the collateral. Lenders fall for this because, as this handwritten ledger represents, legacy record-keeping is fragmented. The banks have no shared system to cross-reference collateral and realize they are holding competing claims for the same asset. The WAO neutralizes this through the Physical Delivery Orchestration Agent. Tying the programmable asset directly to physical reality closes the gap. IoT sensors track weight, RFID tags, and location data, feeding a single, verified digital representation of the asset into the Wisdom Vault. Operating under a shared governance protocol, the delivery agent uses this exact asset state to coordinate inspectors, logistics providers, and counterparties simultaneously. The moment a lender registers a financing claim against the digital asset, that claim is immutably recorded. If a second lender attempts to register a claim against the exact same pallet, the network instantly flags the duplication and rejects it. By anchoring the digital token to sensor-verified physical reality, the network makes double financing mathematically impossible. The final major market vulnerability exists in ESG compliance tracking. Current ESG tracking relies on static documentation. Companies hire auditors once a year to produce self-reported point-in-time certificates that are practically impossible for secondary buyers to verify. This reliance on paper creates an environment where greenwashing thrives across the global supply chain. Because there is no continuous visibility across different stages of the supply chain, bad actors easily obscure their actual carbon intensity or water usage during the months between their annual audits. The solution is the ESG compliance agent. Rather than waiting for a yearly report, this agent continuously ingests real-time telemetry from the source. It reads water usage, exhaust sensor output, and labor records as they happen. This raw telemetry is mapped directly to the programmable asset residing inside the Wisdom Vault, updating its compliance status by the minute. A traditional audit relies on a human reading corporate spreadsheets months after the fact. The agent audits by pulling tamper-evident sensor data directly from physical equipment. Resolved, the ESG compliance agent replaces corporate claims with verifiable certification, enforcing actual environmental standards at the commodity level. Zooming out, we see the entire commodities ecosystem governed by a unified WAO architecture. The commodities WAO operates as a necessary governance layer. Commercial exchanges cannot implement these protocols themselves because their status as centralized entities creates structural conflicts of interest. The WAO replaces interpersonal trust with institutional intelligence. Institutional intelligence is the capacity of a system to learn from its own experience. The network senses the state of the market, remembers its historical data, and coordinates its agents, improving its collective judgment over time. When the coordination costs drop and the risk of fraud is mathematically mitigated, the macroeconomic impact extends to the foundation of the supply chain. Lowering the overhead of trust democratizes access to risk management. It allows smaller market participants to utilize hedging tools and pricing instruments they need. The legacy system's high barriers to entry excluded smallholder farmers and emerging market refiners, forcing them to absorb price volatility alone. The WAO extends the market's safety net to these independent producers. By utilizing the Wisdom Vault and specialized AI agents, the WAO enforces physical reality over paper claims. We are watching trillions of dollars in physical assets migrate from filing cabinets to programmable software objects. As institutions audit their own coordination debt, the shift to a WAO architecture becomes a matter of economic survival. It ensures that the coordination machinery finally serves the real economy, turning the debt of the legacy era into the intelligence of the next.